let's take the question number 1. Sorry. Bima Limited acquired 65% of shares on 1st June 2011 in NAFA Limited, which is engaged in production of components of machinery. NAFA Limited has 1 lakh shares of 10 each. The quoted market price of shares of NAFA was 12 on date of acquisition. The fair value of NAFA Limited identifiable net asset on 1st June 2011 was rupees 80 lakhs. Bima Limited wired 50 lakh in cash and issued 50,000 shares as consideration on date of acquisition. The quoted market price of shares of Bima on date of issue was rupees 25 per share. Bima Limited also agrees to pay additional consideration of rupees 15 lakhs if the cumulative profit earned by NAFA exceeds rupees 1 crore over the next 3 years. On the date of acquisition, NAFA assessed and determined that it is considered probable that the extra consideration will be paid. The fair value of this consideration on the date of acquisition is rupees 9,80,000. NAFA Limited incurred rupees 1,50,000 in relation to the acquisition. It measures non-controlling interest at fair value. How will the acquisition of NAFA be accounted by Bima under Ind AS 103? Prepare detailed workings and pass the necessary journal entry. See, friends, as you might be knowing, Ind AS business combination states that where one entity acquires control of one or more other entities, it results in a business combination. At the time of acquisition, the assets and liabilities of the acquiring company should be incorporated in the books of acquirer at fair values. On account of that, there may be a difference between the carrying amount and the fair value, the tax base, which may result in a deferred taxation. Now, in this problem, the consideration payable is given, which includes a consideration payable of 15 lakhs, which is contingent upon, the acquiring company profit being more than 1 crore over the next 3 years. Where there is a certainty about the extra consideration being paid, that shall form part of the consideration. But since it will be paid after 3 years only, we will have to take into consideration the present value of such amount to be paid after 3 years. That is also given in the question. As you can see, Bima Limited agrees to pay additional consideration of 15 lakh if the cumulative profit earned by NAFA exceed 1 crore next 3 years. So the next 3 years put together, if the profit is more than 1 crore, then Bima will pay another 15 lakhs. So when they will pay this 15 lakhs? The 15 lakhs will be paid only at the end of 3 years, only when they are clear and certain that the profit earned over the last 3 years is more than 1 crore. So will it be certain? Yes, the problem says on the date of acquisition, NAFA assess and determine that it is considered probable that the extra consideration will be paid. So therefore, we have to find if after 3 years I will have to pay 15 lakhs, what is its present value? That is also given in the question, 9,80,000. But this is in addition to the consideration already agreed, 50 lakhs in cash and 50,000 shares on the date of acquisition, on which date the quoted market price was 25 per share. So what will be the total consideration? We have to find out on the date of acquisition, including the consideration contingent upon the cumulative profit to be earned over the next 3 years. And we have to consider on the date of acquisition, what is a non-controlling interest? According to the problem, they say it should be measured at fair value. So find the aggregate of that, compare that with the net assets of the acquiring company as on date of acquisition to the extent of the share acquired. The difference, if any, should be recognized as goodwill if it is positive. If it is negative, it will be taken as gain on bargain purchase. And of course, it will be shown as a separate component of equity as capital reserve in the balance sheet after acquisition. So I do hope, I do believe that all of you are clear about this. Now they're asking you, how will you account this business combination? Whether this is a business combination or not. That's the first question. I've already given the answer. How will you record this business combination is a question. That means what? No doubt it is a business combination. But sometimes the question may not tell you that. So it's always better to determine whether this acquisition of 60% of shares in another company results in a business acquisition. What is the answer? According to Ind AS 103, if one entity acquires control over one or more other entities by acquiring the shares or by any other manner or by terms of an agreement, it results in a business combination. So the problem tells you that Bima acquired 65% of shares in NAFA, which is more than 50%. That means they're acquiring control. Bima is acquiring control over NAFA. So it's very, very evident and crystal clear that there is a business combination. Bima is acquiring NAFA. How accounting should be done, as I told you, the net identifiable assets of the other acquiring company should be recognized at fair value. Then we have to compare that with the consideration payable and the non-controlling interest. According to problem, they say it should be measured at fair value. The difference of goodwill or capital reserve should be recognized. If suppose the tax rates are given and the tax base of the assets and liabilities and the carrying amount are different, it may result in a deferred taxation in accordance with Ind AS 12. That also to be taken into consideration. And then we have to calculate the value of bargain purchase of the goodwill. And of course, finally, we have to make the journal entry for recognizing the assets and liabilities of the acquiring, the consideration paid, and which may have resulted in a capital reserve or a goodwill. And if there is a probability of deferred tax asset or liability, that also to be considered. So that's how we will have to go forward, do the calculation, and present the answer to this problem. Hope you have read the problem completely. Of course, one more information is given in the problem that NAFA Limited incurred $150,000 in relation to acquisition. So this is an expense incurred in the course of a business combination that shall never form part of the consideration. That will be expense in the year in which the acquisition or the combination happens. Okay, right. Now let us see how to present the answer for this problem. So they're asking you how you will account for the acquisition. Detailed workings you have to show, and you have to make the necessary journal entry. So three things they're asking you: working, journal entry, and how will you account it. So this problem may carry 6 to 8 marks in the examination, provided we get everything right and in a proper order we present the answer, and if that is acceptable to the examiner and if that is the correct answer, definitely you'll be getting the full credit for your answer. Let's now see, friends, how to present the answer to this problem. As I told you, we have to determine the goodwill or capital reserve on consolidation as on the date on which control is acquired. It is also known as determination of cost of control. How do we do that? See, friends, as I told you, what is the total consideration? Bima Limited agreed to issue 50,000 shares, which quoted price on date of acquisition was 25. So multiply issue of share 12,50,000. They agreed to pay a cash consideration of 50 lakhs. Then contingent consideration payable after 3 years if the cumulative profit exceeds 1 crore. The problem says it is probable. That means it is more likely to happen than not. So necessarily we will have to create a provision for that. So the contingent consideration of 9.8, since it is payable after 3 years, you have to find the present value by applying the appropriate discount rate based on pre-tax rate. But all that is not required because the fair value is already given in the question. So add it. So 1250 plus 50 plus 980. The consideration transfer date of acquisition is 72 lakh 30,000. Find the value of NCI based on fair value. That is what is given in the question. The value per share of NAFA Limited is given in the question as 12 rupees on date of acquisition of control. Since Bima acquires 65%, others will hold 35% in that. So what will be the value? It will be 1 lakh into 35%. That means 35,000 shares at the rate of 12, 4 lakh 20,000 rupees. So the total of consideration plus fair value of NCA is 76 lakh 50,000. This should be compared with the net assets of the organization. If consideration is more, the difference will be goodwill. If net assets is more, the difference will be taken as gain on bargain purchase. In this problem, what is the net assets? 80 lakhs. So on date of acquisition, the net assets of NAFA Limited is 80 lakhs, whereas the consideration plus NCI at fair value is 76.5 only. So the benefit is more than the outflow. That means you're getting a profit, which will be recognized as a gain on bargain purchase and will be shown as capital reserve as a separate component of equity in the balance sheet of the acquirer company. So in this case, 76 lakh minus 80 is 3 lakh 50,000 capital reserve. So the first step in any problem on business combination is to find this. See, stamp duty and all these costs incurred in relation to the business combination shall be expensed in the year in which the acquisition happened. NAFA Limited paid 1,50,000 rupees for the purpose of this business combination. It will not be considered as part of the consideration. According to Ind AS 103, such expense will be transferred to P&L in the year in which acquisition happens or the year in which the control is acquired. So that 1,50,000 should not be considered. Hope everything is clear, right? Now, how do you account for this journal entry? That's quite simple, right? All the assets, liabilities taken over is debited, identifiable net asset. The details of assets and liabilities are not given. Therefore, debit the identifiable net assets, credit the NCI, credit the capital reserve, credit the consideration, including the provision for contingent consideration. 50,000 shares are given at 25 each. 10 rupees face value that goes to capital. 15 rupees excess over face value goes to premium. Cash consideration resulting in reduction of bank balance 50 lakhs. Provision for contingent consideration 9 lakh 80 at fair value. NCI measured at fair value 35,000 shares at the rate of 12 is 4 lakh 20. Cap reserve just we found out is 3 lakh 50,000 rupees. That's it. This is how the accounting of acquisition should be done by Bima Limited. In the books of Bima Limited, this is how accounting will be done. And of course, if the problem asks you to prepare the balance sheet after merger, then these assets and liabilities will be integrated with the asset liabilities of Bima Limited. And the issue of equity shares, premium, all that will form out of equity. Cash balance reduces. Provision for contingent consideration will appear under non-current liability. Capital reserve will be shown under equity, separate line. Then NCI will also be shown separately under the other equity. This is how the accounting should be done, and this is how you would be preparing the consolidated balance sheet. So what could be question number 2? Any guesses? Or if it is already shared with you, I am maybe asking your answer for a known question. But see, friends, just now we were discussing about deferred taxation, is it not? This problem is going to take into consideration the tax rates in the respective jurisdiction. We are also going to account for the goodwill, if any, here, and we are going to consider the impact of the temporary difference, and does it result in a deferred tax asset or liability? We are going to find out, and accordingly we are going to account for the business combination. This problem will take care of that. Friends, let's take the question number 2. On 1st January 2020, entity H acquired 100% capital of entity S for 15 lakhs. So consideration is very clearly given. 100%, H is parent, S is subsidiary, very clear. The book values and the fair values of identifiable assets and liabilities of entity S at the date of acquisition are set out below, together with their tax basis in entity S's tax jurisdiction. Any goodwill arising on acquisition is not deductible for tax purpose. Generally, it is not deductible because goodwill arising because of business combination only, and that will be capitalized as an intangible asset, as an acquired goodwill. So definitely such goodwill will never be allowed as deductible for tax purpose. The tax rates in entity H and entity S jurisdiction are 30 and 40% respectively. So 2 rates are given, friends. That is where the confusion may start. Okay, which tax rate we should be applying, that we should be very clear in our minds. Okay, as we go forward, we will get to know how to solve this problem. So the assets and liabilities taken over, book value is given, tax base is given, fair value is given. Book value is as per the books of accounts of the subsidiary. Tax base is the value of such asset for the purpose of taxation. Fair value is based on the current cost or the current market prices. But as you very well know, where there is a business combination accounting to be done as per India's 103, we will have to account or recognize the assets and liabilities of the acquiring company in terms of its fair value. So therefore, the book value is of no consequence in this problem, because in the acquirer company, we are going to recognize land and building, property, plant, inventory, all assets and liabilities based on the fair values. But the tax base for these assets and liabilities are different. So necessarily it will result in a temporary difference. It could be a taxable or a deductible temporary difference. If it results in a taxable temporary difference, it gives rise to a deferred tax liability. If it results in a deductible temporary difference, it gives rise to deferred tax asset. So to find the difference, then multiply the appropriate tax rate which is applicable in the jurisdiction. Then you will determine the deferred tax asset or liability, which will be considered at the time you determine the value of goodwill or bargain purchase. So let us clearly understand what is the import of this problem, on the solution. As you can see, the tax base of land and buildings 500, fair value is 700, PPE 200, 270. In almost every asset you find there is some difference. Whereas account receivable, cash and cash equivalent, account payable, retirement benefit obligation. Say in these 3, there is no difference, doesn't result in any temporary difference. Whereas here, tax base is 0, fair value 100, like that it is given. So necessarily, temporary difference will arise, resulting in a deferred tax asset or liability. So you are required to calculate the deferred tax arising on acquisition of entity S. Also calculate the goodwill arising on acquisition. So 2 things you have to calculate. First is the deferred tax, Then, if any goodwill arises on acquisition, take into consideration the deferred tax also and determine the goodwill on acquisition. That is how we are going to take it forward, friends. This problem is capable of fetching you minimum 8 marks. Suppose the paper setter is a little bit, what do you say, generous. He can give you even 10 marks for this. So these are all standard exam standard problems. So please don't miss anything like this. Practice problems like this. Definitely you can do very well in the examination as regards this particular standard is concerned. Now, therefore, friends, how to determine net asset acquired? It's very elementary, right? Because as students of final course, should I tell you how to find net assets acquired? Assets minus liabilities, that's all. So tax base and fair value. Fair value is the value at which the acquirer company will recognize the assets and liabilities in the books of accounts on account of business combination. So in the books of accounts, the net asset will be 1070, whereas for the purpose of taxation is 920. Okay, is there a temporary difference or not? Yes, there is a difference. It is equal to 150,000 or 15 lakhs or whatever. Correct, no? If that is the difference, whether that difference is a taxable temporary difference or a deductible temporary difference, how do we find out? We have learned it already in days 12. If the carrying amount of an asset is more than its tax base, then the difference that arises temporarily is in nature of a taxable temporary difference. That means it will result in a deferred tax liability. Okay, here you can see the assets and liabilities of the acquiring company will be recognized in the books of acquirer at fair value. So in the books, this will be the net asset, whereas for the purpose of tax, 920. So whether the carrying amount is more than tax base or not, yes, by 150,000. Therefore, this is a taxable temporary difference which will give rise to a deferred tax liability. Let us see how it goes. See, the fair value of net assets of subsidiary is 1070, whereas tax base is 920, resulting in a temporary difference of 150,000. Is what? Lakh and 50,000. Sorry, I said 15 lakh. No, it's lakh and 50,000. On that, we should apply 40% tax rate. Now, why not 30%? See, these are asset liability relating to S Limited subsidiary. So the tax rate applicable to that jurisdiction only shall be considered for the purpose of determining the deferred tax asset or liability. So in this problem, it is given entity S's tax rate is 40%. So therefore, on lakh and 50,000, apply 40%. The deferred tax liability will be 60,000 rupees. Now, what is the consideration already given in the question? 15 lakhs. Net asset taken over at fair value is 1070. Now, if you recognize the deferred tax liability also into consideration, the net assets will become 1010. Further liability of 60,000 arises on account of business combination in the nature of deferred tax liability. Therefore, the net asset acquired will be 1010. Whereas the consideration is more than that by 4,90,000. Therefore, in the books of entity H, this will be recognized as an acquired goodwill at 4,90,000. So we have calculated the deferred tax. We have calculated the goodwill. Let us see how the accounting could be done. If it is asked in the question, we should do. If it is not asked, we need not do. But let us see whether we are showing that also. tax base of goodwill is nil. Because earlier there is goodwill was never known as far as the income tax department is concerned. Tax base is nil. But in the books, we are recognizing 4,90,000 as goodwill. So therefore, deferred tax will not arise on account of goodwill, arising on account of business combination. On account of initial recognition of assets and liabilities at fair value, if any goodwill arises, deferred tax on that should not be recognized. So the deferred tax and other differences to be provided at 40%, not 30%, because the tax rate for entity S's tax jurisdiction is 40%. There only the difference arises. It will be reversed in that jurisdiction only. Therefore, we have to consider 40%, not 30%, for the purpose of determining the deferred tax liability. So, friends, we got the answer. Now, let us take another interesting question. Veera Limited, Zira Limited, both in the business of manufacturing and selling of lubricant. Veera and Zira shareholders agreed to join forces to benefit from lower delivery and distribution cost. The business combination is carried out by setting up a new entity called Meera that issues 100 shares to Veera shareholders and 50 shares to Zira shareholders in exchange for the transfer of shares in those entities. Say, if you think 150 are very small numbers, you put 100 crore shares and 50 crore shares. It is, you see, actually, this question is not, based on the numbers. This question is based on the understanding of the basic principles of the standard. So you don't have to worry that only 100 shares are given or 50 shares are given. It's not relevant as far as, the quantum or the volume is not relevant as far as this problem is concerned. The number of shares reflects the relative fair value of entities before combination. This is a very, very critical sentence, friends. The number of shares reflects the relative fair value of the entities before combination. In other words, I can tell you that the value of 50 shares of Zira is equal to value of 100 shares of Veera. That's all. So which company value is more? You can easily understand, right? Also, respective company shareholders get voting rights in Meera based on the respective shareholding. The same proportion in which the shareholders of Veera and Zira were holding shares in the respective companies, the same proportion they'll be getting the shares in the new entity, that is Meera Limited. See the question. Determine the acquirer by applying the principles of Ind AS 103 business combination. Very, very important, friends, as far as business combination standard is concerned, is to identify the acquirer. Then we have to calculate the consideration. Then there is a possibility of deferred taxation. Then determining the cost of control. After that, accounting. Then balance sheet. That is the order, is it not? Of course, what is the acquisition date? That also we have to find out. So this problem is a very good problem, friends. It may fetch you 6 marks. Definitely not more than that. But unless you are able to determine the acquirer for the purpose of accounting the business combination, your knowledge is not complete as regards the standard. So, how to determine the acquirer? See, very easily we can say there are 3 companies, Veera, Zira. They are merging. They are forming a new company called Meera. Meera will acquire Veera and Zira. That is how it appears. Meera acquires Veera and Zira by issuing 100 shares to shareholders of Veera, 50 shares to shareholders of Zira. So the outset, it appears as if Mira Limited is the acquirer, Vera and Zero are the acquiree. It appears like that. Legally, that is right. You understand, friends? Most of the time, the legal acquirer will be the accounting acquirer. The legal acquiree will be the accounting acquiree, no doubt. But under certain circumstances, a legal acquirer may not be the acquirer for the purpose of accounting. So the legal acquirer could be a different person, accounting acquirer could be a different person. If that situation arises because of the agreement between the companies, we call that as a reverse acquisition in accordance with Ind AS 103. So whether this problem is based on reverse acquisition or not, we have to find out. In case of reverse acquisition, it is not the entity that issues share that is acquired, it is the entity that receives the equity instruments becomes an acquirer. So whether Vera Limited or Zero Limited is acquirer or whether Mira Limited is acquirer, there is some confusion possible as far as this problem is concerned. So that's why these kind of questions are being asked in the exam, and they're testing whether there is complete clarity, in your knowledge relating to this standard. It's purely theoretical, friends. Little bit of calculations. So you cannot write the answer in one sentence. Mira is acquirer, zero. Not like that. You have to write what is given in the standard in your own words. Definitely don't worry to reproduce, whatever is given in the standards. It is not practically possible, and it's not required also. Because in my opinion, what is the point in reproducing the standard? See, as chartered accountants, we are supposed to understand. You can change some words here or there, but not the substance. The concept or the principle cannot be, different. But if you can put different words to convey the meaning, that is fair enough. I never believe in reproduction of anything in the study material. And nobody has ever told anybody that if you reproduce the answer given in the RTP or study material, will be given full marks. It's not like that. So have you understood the question? Do you know how to apply the standard? If possible, you reproduce. Not possible, do not worry about that. Correlate, the principles given in the standard with the information given in the question, come to a conclusion, then give your answer. That is the way we should present answer for these kind of questions. Very, very good question, friends. As I would have told you earlier also, if you are aware of the specific number of the paragraph, you can mention, but don't take a chance. If you are not aware of the particular paragraph number, don't commit. But we very well know business combination is governed by Ind AS 103 that you mentioned. It is not that you are writing a new standard, right? Already a standard is there for business combination. The number is 103, that much we know. Some of you may have clear idea about the paragraph numbers also. If you have that, well and good. Nothing wrong in writing it. But writing a wrong paragraph number will cause greater damage rather than not writing the paragraph number. So wherever I knew the paragraph number correctly, I will quote it. But if I have some doubts on that, I will not quote it. I will simply say, yeah, this is as per this particular standard. Ind AS 103. So, what does this particular paragraph says? A business combination affected primarily by exchanging equity interest. See, there is no cash movement or asset transfer here. Only equity interests or exchange. Who is the acquirer? The acquirer is usually the entity that issues the equity interest. In this problem, Mira Limited is issuing the equity interest to acquire the equity interest from both the companies, Mira and Zira. So therefore, at the outset, it appears as if Mira Limited is the acquirer. But as I told you, in some business combination, commonly called reverse acquisition, the issuing entity is the acquiree for accounting purpose. That's all. For accounting purpose, it is acquiree. Legal acquirer is Mira Limited. There is absolutely no doubt about that. But it is not just by applying this. We have to take into consideration other important facts and circumstances, read the terms of agreement between the companies, then come to a conclusion. What are the other factors to be considered, friends? The relative voting rights in the combined entity after the business combination. After the business combination, what will be the relative voting rights of the combined entity? We have what is that? Vera, we have Zira. So the shareholders of Vera and Zira are going to become the shareholders of Mira Limited. What is going to be the relative voting rights in the new company? That will decide who is the acquirer. So who will be the acquirer in such cases? The acquirer is usually the combining entity whose owners as a group retain or receive largest portion of voting rights in the combined entity. Who is going to receive the major portion of voting rights in the combined entity, whether it is the shareholders of Vera or shareholders of Zira. Based on that, you can identify the acquirer. So, acquirer shall be either of combining entity Vera or Zira, whose owners, that I've already told you all that, it's like as if, I tell you, then it is being typed. It's not like that. It's already there. I'm telling you upfront and I'm showing you all that. But please don't need to write anything, note down anything. Note it down here. This is the best storage. You can use it anytime. So in the above scenario, out of 150 shares, the shareholders of Vera will get 100 shares. That means they get 2/3 voting rights in Mira Limited, whereas Zira Limited shareholders will get only 1/3 share. So who has got major portion of the voting rights in the new company? The shareholders of Vera Limited has got the maximum voting interest in the new company because they will get 100 shares. Zira shareholder will get only 50 shares. So if 150 shares, 100 goes to Vera, 50 goes to Zira. Shareholders of Vera hold 2/3 of the total shares issued by Vera Limited. So it's as if, Vera is acquired Zira, then they formed Mira. It's like that, you understand? So according to the principles of Ind AS 103 and based on the information given in the problem, we are very clear that Vera Limited is the acquirer as per Ind AS 103. This is probably the best way to present an answer to this question. Let's take up this question. Company X is engaged in the business of exploration and development of oil and gas blocks. Company X currently holds participating interest in below mentioned producing block as follows. Some block name is given, doesn't matter. But in that block, Company X holds 30% participating interest, Y 60%, Z 10%, total 100%. Okay, clear. For the above block, Company XYZ has entered into an unincorporated joint venture. It's not registered, just they have an agreement. It's a joint venture. Company Y is the operator of block AWM01. Okay. Company X and Z are the joint operators. Okay. Company Y incurs all expenditure on behalf of the joint venture and raise cash call to company X and Z at each month end, respect of their share of expenditure incurred in joint. That is the procedure they follow. See, all the operational activities are taken care of by Y. X and Z will involve in the production activities. Whatever expense are incurred on behalf of the venture, Y will incur that. At the end of the month, they will be sending a statement to company X and Z. They'll be collecting the money from X and Z. All the manpower, requisite facilities, machinery owned by joint venture and thereby owned by all the joint operators. It's not just they are making use of a particular asset. They're using all the manpower or requisite facility, machinery. It is all owned by the venture. So it is owned by all the joint operators. All these information are very, very critical. You have to read it carefully, friends. For the past few months, due to liquidity issues, company Z defaulted in payment of cash calls to operators. Therefore, the company Y has issued notice to company Z for withdrawal of their participating right from 1st April 2001. However, company filed an appeal with the arbitrator on 30th. So some problem is there. Company Z is not able to make the payment. So company Y said, why don't you withdraw from the participating right? We will take care of that. Z is not agreeing, so they filed an appeal with arbitrator. But unfortunately, company Z financial position has not improved. So therefore, Z decided, okay, I'll withdraw the participating rights. And therefore, they entered into an agreement with company X and Y. As per the terms of agreement dated 31st May 2011, company X will receive 33.33% share. Y will receive, that's 1/3 will go to company X and 2/3 will go to company Y. Even though Z had filed an appeal with the arbitrator, later they thought it's of no use. So let us now withdraw from that. We will, transfer the participating right as 1:2 to company X and Y. Company X is required to pay 1 lakh against 1/3 share of participating rights owned by company Z. Okay, after signing the sale agreement, company Y approached the government of India for modification of the production sharing contract. That is removal of company Z from the PSC, and government has approved this transaction on 30th June 2011. Government approval for modification in PSC is essential given the industry in which the joint operators operate. That means unless government approval is obtained, Z cannot be made to withdraw from the participating interest. So that is an essential condition. Okay. That is also a very, very important critical point based on which questions may be asked. Balance sheet of company X and Z are as follows. So they have not given any information about Y. They're focusing only on X and Z. 31st May, 30th June, they are given the list of all the non-current assets, including right of use, development, capital, work in progress is development CWIP, financial asset, loan receivable, total current assets given, current assets inventory, financial asset, trade receivable, cash and cash equivalent, other current asset. So this row, you can just ignore it. One additional row, right? Other current asset. Therefore, the total asset is 13,50,000 on 31st May, 23 lakhs on 30th June, and same is the case for company Z also on both the dates, May as well as June. The total assets are given. Similarly, the equity and liabilities, equity capital, other equity, total equity given for both company X and Z as on 31st May and 30th June. I'm assuming you have read all this information. Then liabilities, non-current provision, other liability. So total non-current, current liability includes financial liabilities, trade payable, total current liability. So total liability, of course, would be same as the total assets on the respective dates. So even though company X, Y, and Z are involved, now they reduce the problem between X and Z only. Okay, so what Y does will not be of any consequence to us as far as this problem is concerned. Sorry. Additional information. Fair value of PPE and development work in progress owned by company Z as per the market participant approach is 5 lakh and 2 lakh respectively. So the company Z's PPE and development capital work in progress will be taken over by company X and Y in the ratio 1:2. Fair values are given. So you can understand there is a business combination happening here. One company is taken over by two companies. 1/3, 2/3 in the proportion. X and Y are taking over Z. Now we are focusing on the fair values of PP and development capital in progress of the company Z. Fair value of all the other asset liabilities acquired or assumed to be their carrying values except cash and cash equivalents. Cash and cash equivalents of company Z not to be acquired by company X as per the terms of agreement. So other than cash and cash equivalent, all other assets and liabilities are taken over at fair value other than PPE and development capital work in progress. Tax rate assumed to be 30%. Probably there is a deferred taxation because of the difference between the tax base and the carrying amount, which may result in a taxable or a deductible difference, giving rise to deferred tax asset or liability. Accordingly, the value of goodwill or capital reserve might change. The tax rate is given, so we have to make use of that to determine what could be the deferred tax asset or liability. Now again, you might want to ask me, sir, if tax rate is not given, should I consider that? Should I assume it? In my opinion, it would be nice if you assume it. But if you do not want to complicate things, don't assume it. Just leave it off. But where the tax rate is given, you don't have a choice. You will have to take that into consideration. If rate is not given, the option is ours. But if you're not taken into consideration or you not assumed any tax rate, please mention in the problem. Since the tax rate of the jurisdiction is not available in the problem, I have not considered the impact of the temporary difference resulting in deferred tax as a liability. Just write it as a note to your answer. You write it. That will be, fully acknowledged by the examiner, and due credit will be given for that. Or you assume tax rate to be 30%, calculate the temporary difference. If I were in your place, I will assume, because my answer will be better, qualitative than others. But there is a risk involved. I'm assuming the tax rate, I'm finding temporary difference. Suppose it is wrong. Suppose the calculation goes wrong. Accountant should be conservative, is it not? Since I am confident that I'll get the answer right, I will go for that because I want to get better marks. But if you believe that the confidence is not there, there may be some mistakes, you do not want to take the risk, just ignore it. So the choice. But here, of course, we do not have a choice. As per India's 28, all the joint operators are joint venturers, whereby each party that have joint control of the arrangement have rights to the net assets of the arrangement. Therefore, every operator record the share of asset liability in their books. So the nature of the agreement between these three companies, XYZ, is a joint operation resulting in giving rights to net assets of the arrangement. Therefore, this will be recognized as a joint venture, and when you prepare the balance sheet of the respective companies, you have to consider not only the assets and liabilities of your company, but also your share of assets and liabilities from the acquired company. So that's what they're trying to tell you. Please make note of this very significant and important information. Now the various questions. Number one, whether the above acquisition falls under business or asset acquisition as defined under business combination standard in days 103. Because suppose it is purely an asset acquisition, then this standard is not applicable. When Ind AS 103 becomes applicable, only when there is a control taken over by one entity over others. That means they're acquiring the business as a whole, not a particular asset. So necessarily, we'll have to first identify whether this acquisition of 1/3 of company Z by company X is a business acquisition or an asset acquisition. If it happens to be a business acquisition, then only we should apply Ind AS 103. Determine acquisition date in the above transaction. So what is the answer for question number 1? Very simple. If it is not a business acquisition, where is the need for acquisition date and all? So therefore, it's very, very clear. It's a problem on 103. It is business acquisition only. But they're asking you, is it business or asset acquisition? Then you have to write down what is the meaning of business as per Ind AS 103. Whether the 3 elements are there, input, process, output is there. You have to descriptively write all that. Then you have to come to a conclusion that because all these elements are present in this acquisition, it will be recognized as a business acquisition. Therefore, it is governed by Ind AS 103 business combination. And once you identified that, you have to identify the acquirer. You have to identify the acquisition date. So therefore, friends, when they're asking you to determine the acquisition date, it is an indication to you that this acquisition is a business acquisition, not an asset acquisition. So most of the times, the answer for the previous question may be in the second question. If you are smart enough, you'll get that. Right? Pass journal entry for the above mentioned transaction. They have not mentioned combination, they said transaction. That means they're trying to keep you still, in suspense. But already we know the answer. So no problem at all. Prepare the balance sheet for company X based on your analysis in part 1 above as at the acquisition date. That means if you believe it is a business acquisition, draft the balance sheet based on that. If you think it is asset acquisition, prepare balance sheet as of that. That is what they're trying to tell you. So see, to read the question itself takes a lot of time, but I have deliberately read it slowly and I've explained to you every part of the question so that when we present the solution, I hope it will be more clear to you, friends. But when you do it in the exam, I don't think you should spend more time on reading. Of course, you know everything on what is given. Just read it once. No need to worry about the items given in balance sheet and all. Definitely a tally balance sheet will be given. But there are some critical points in the question that has to be clearly noted down in our minds. Now, presentation of the answer for this problem, friends. We have to answer the question number 1. Whether this transaction where company Z has given up, its participating right or interest in favor of other companies ratio of 1:2, is it a business acquisition or an asset acquisition? You have to answer that question. Now, friends, definitely you should be writing something descriptively like this in days 103. Here the relevant paragraphs and are not given. See, that's what I told you. What is the meaning of business as per this standard? we have to write down that. I don't want to read it, set of activity, all these things are there. Please write it fully or to the extent no need to reproduce, but try to write it in your own words to the extent you have understood. But at least I will tell you, see whether you have mentioned the terms IPO, input, process, output. That's it. So it's integrated set of activities and so on and so forth. It is generates some income. There is a process. That's a result in output. That is how the word business has been defined in Ind AS 103. So whether a transaction meets the definition of a business combination such that you will apply the acquisition method. What you should see, whether the entity acquires control over the integrated set of activities rather than a collection of assets or a combination of asset liability. Are they acquiring a business or are they acquiring some assets and liabilities? That clarity should be there. So that's what I told you, friends. Please remember to write this input, process, output. Remember, IPO, input, process, output. So in order that a transaction results in a business combination, these three elements should be present. Input is there, process is there, output is there. If it is there, yeah, it's a business acquisition. So therefore, there should be an input, a substantive process should be there, which will significantly contribute to the ability to create output. Whether the transaction between X, Y, and Z comprises these elements. Yes, the output is there. Input is whatever operation we are going to do. Participating right is owned by company Z for producing the block. So what is output? Output is producing the block. We are not acquiring just some assets. We are going to use the manpower, requisite facility, machinery. It's given in the problem that all are owned by the venture. Therefore, it is owned by all the joint operators. Therefore, an acquisition of the participating rights implies that you are acquiring the business inputs, manpower, expertise, machinery, resources you are taking into consideration. Is it having the ability to create output? Yes. By using those resources, by applying those resources into a process, I will be producing the block, that is the output. So therefore, friends, this acquisition will fall under business acquisition, and therefore you would apply Ind AS 103 business combination. So very clearly, you should be able to write such that examiner is impressed with the way in which you write. But remember, as I told you already also, no need to reproduce anything, but remember to write the keywords, that is comprised in the definition of a business. And based on the definition, try to correlate what is happening here, then come to the conclusion. Then who can, prevent or deny any marks to you for this problem? Definitely you'll get full credit for your answer. So now we have to answer the second question. What is the acquisition date? Now we are clear. The acquisition of a portion of the participating rights by X of Z and by Y of Z is a business acquisition. Therefore, we should apply acquisition method of business combination in Ind AS 103. But for that purpose, we should know the acquisition date. Why? When you account for a business combination, the assets and liabilities of the acquiring company should be recognized in the books of accounts and financial statement of the acquirer based on the acquisition date fair value. So what is the acquisition date is paramount. Why there is a confusion in this problem? 1st April problem arose. Company Y sent a notice. Z did not accept. 31st May they decided they entered into agreement. Later, company Y applied for a modification in the agreement. Government has approved on 30th June. This is the sequence of happenings. Now, which date is the acquisition date? Is it 1st April or 30th April or 31st May or 30th June? So what does the standard say about that? According to paragraph 8 of Ind AS 103, the date on which acquirer obtains control of the acquiree is the acquisition date. On which date company X and Y acquired control over company Z? Paragraph 9 of Ind AS states that the date on which acquirer obtains control is generally the date on which acquirer legally transfers the consideration. Date on which consideration is given, the date on which the assets and liabilities are taken. But there is a possibility that the consideration might have been given earlier or later. Acquirer might obtain control on a date which is not the date on which the consideration is transferred or the date on which the assets and liabilities are taken over. That is also possible. What about the information in the problem? Again, we should not just go by what is there in the problem. We should get into the agreement and also the relevant points as regards the standard. It's very clearly given in the question that government approval is essential. So without getting government approval, the transfer of participating right will not take force. Therefore, even though the application is sent by company Y on 31st May, the government has approved the process only on 30th June. Therefore, acquisition date in this or for this problem will be taken as 30th June 2011. So it's not 1st April, it's not 30th April, it's not 31st May. Date on which government has approved this transaction or approved this transfer of rights, that is the acquisition date. Therefore, when you see the problem they're given, the balance sheet of X and Z on two different dates, 31st May, 30th June. So whatever information given on 31st May is not relevant. Deliberately or just to test you how clear you are, they're given the balance sheet on two different dates. But now your mind is clear. We have to consider the assets and liabilities of both company X as well as Z as on 30th June only, because that is the acquisition date. Now, what is a journal entry for acquisition, friends? It's quite simple, is it not? All assets taken over debit, liabilities assumed credit. It may result in a deferred tax asset or liability. Then finally, there may be a goodwill or gain on bargain purchase. Friends, we cannot make this entry unless we have determined the gain on bargain purchase or the deferred tax asset or liability. These things are given in the working notes, friends, but the solution should be presented in the order in which the question asks you to do. So we answered question number 1. Who is the acquirer? Sorry, what is the question? Is it business acquisition? Second question, acquisition date. Third question, account for this. So we have accounted that. But you may tell me that, sir, I'm not aware of the numbers. How will I do that? No problem. Just leave this blank. After that, you are going to show the balance sheet along with notes also, which may take another 2 pages. So maybe this, after this 2 pages, you leave, go to the working notes. There you calculate at what value the assets and liabilities of companies that is taken over. Then what is the tax base? What is the temporary difference? Find if there is any deferred tax asset or liability. Then compare that with the consideration, resulting in a gain on bargain purchase or not. Since we have already done it and we'll be showing you the working note at later point of time, we are displaying this slide to you now. Okay, because this is how the answer, the solution will appear for the examiner. Don't do working note inside. I know you're all, at the final level. Working note will always be shown at the end, but you'll be using that information here. And working notes, you should be giving proper numbers, no? Working note number 1, 2, 3, 4. Please give that reference here. So, let me tell you, property plant equipment is 166650. How? In the adjustment, it is given the fair value of PPE on the date of acquisition is 5 lakhs. Company X is getting 1/3 of the participating interest. Therefore, 1/3 of assets and liability value will be recognized of company Z as on 30th June. So 30th June 2011 or 21, whatever the fair value or the book value of assets will be taken into consideration. You may tell me, sir, the numbers are not perfectly correct. No problem. You do it correctly. For example, 5 lakh is the PPE of company Z that is taken over by company X to the extent of 1/3. So if you do it perfectly, it will be 166,667 or 666. But you're taking it as 166,650. It doesn't make much of a difference, friends. You understand? Right of use asset is 20,000, it seems. You have to refer the balance sheet of company Z as on 30th June, which will be 20,000. So 1/3 of that is 6666. You can take it as 6667. Similarly, development capital work in progress. Book value is 1, but fair value is 2 lakh given in adjustment. So 1/3 of that, 16,660 and so on. Loan receivable is also 50,000. 1/3 is 16,665. Inventory, I think it is 30,000 rupees. 1/3 is 10,000 or 9,999. Trade receivable is 1 lakh. 1/3 is 33,330. Other current asset is 50,000. 1/3 is 16,665. So all assets, either fair value or book value, apply 1/3 debit. Credit, same concept, all liabilities. Provision, I think it is 2 lakh. 1/3 of that is 66,000. Other liability 1 lakh 33,000. Trade payable is 2 lakh. So 1/3 is 26,666. Deferred tax liability approximately comes to 30,000 rupees. We will show that calculation later, but that is to be credited. The consideration 1 lakh given in the question. So what is the balancing figure? Asset minus liability minus consideration minus deferred tax liability gives a difference of 19,988, or it could be 20,000 also, no problem. Since the consideration Sorry, friend, there was slight confusion or some network issues. We are back, right? Just give me one moment. Yeah, back, right. So we're discussing this, right? So I will have to show you how I got this 29,997 deferred tax liability, and how we got this 19,998 towards gain on bargain purchase. That I will show in the working note. Now, friends, we are supposed to prepare the balance sheet of company X as on 30th June. How to prepare that? Very easy. The balance sheet of X before acquisition is there. We have to make the adjustment of incorporating asset liability of company Z to the extent of 1/3. Add it, you will get the balance sheet of X as on the acquisition date. That is after the business combination is completed. Like this. Okay. So see here. On 30th June, before acquisition, PP 10 lakh in the books of company X, you're taking over 166,650 of PP of company Z. Add it. Right of use X is 2 lakh, from Z is 6666. Add it. Development CP X is 1 lakh, from Z is 66660. Loan receivable 50,000 and plus. So therefore, the total non-current asset post acquisition will be 16 lakh 6,006. Of course, here it should be 13 lakh 50,000. Maybe 1 0 is missing because of typo error. Next. Current asset, same principle, 2 lakh company X taken over from Z. 9999. Trade receivable company X plus 1/3 of company Z. Cash and cash equivalent of company Z is not taken over. So, but you will be paying 1 lakh, correct? No? So that is deducted. So the after acquisition, the balance will be 3. Out of 4 lakh of cash and cash equivalent of company X, 1 lakh will be paid as consideration, is it not? So the balance will be 3 lakh after acquisition. Other current asset 50,000 plus 16 blah blah blah, you get total current asset like this. Therefore, the total asset before acquisition is 23 lakh and after that is 25, 16, 635. You don't have to check these numbers, friends. It's all already completely verified. So I would just want you to look at it, observe it, understand it, then you can do it. No need to note down anything. Then, of course, the equity and liabilities. Here we should consider equity capital of X only, other equity of X only. Because it's an acquisition, the reserves of Z will not be taken into consideration. But the business combination has resulted in a capital reserve that should be shown as part of equity. So this 19,000 and it is considered as part of equity. Non-current liability provision X plus 1/3 of Z, other liability X plus 1/3 of Z, and this business combination resulted in a deferred tax liability 29,987. That is also considered. So we get the total non-current liabilities and total equity. Finally, current liabilities. Under that, we have trade payable. Company X is 6 lakh, 1/3 of company Z is 66,660. So therefore, the total current liability is 666,660. Hence, the total of equity liabilities. Before acquisition, already given in the problem. After acquisition is 25, 16, 635. That is the total you got as far as assets are concerned. See, for want of space, we are showing in different slides, friends. I'm sure you know how to present it on a single sheet of paper. On a fresh page, you should try to complete the balance sheet in the proper format. So don't show asset one page, liability one page. Don't show only non-current liability in some other page. Take a fresh page. Try to incorporate everything within that one page. So if you need to write so many things, no problem. You can always prepare a note. In the note, you can give the complete details. So it will be one line item, is it not? Like the share capital, equity. That's all. Capital reserve, non-current liability. Like that, you can prepare as many notes as you want, such that the balance sheet is prepared and presented on one page only. It looks very, very, very beautiful, very nice, and very impressive when the examiner happens to value paper. But since we have space constraints, we can't show the entire balance sheet on one slide. Even if I manage to show that, it will be a very small font. You will not understand anything. That's the reason why we are showing it in this manner. I am sure you people will be able to understand that. Now, as I told you, friends, I will now show you the various working notes on 30th June 2021. What is the balance of company Z acquired by company X? Now you will understand how this 166650 came, right? So 3 lakh is the book value on 31 file. What is 33% share is 99,990. But on the acquisition date, the fair value is 5 lakh. So 1/3 of that is 166. So we are not considering book value here because fair value is to be considered for the purpose of accounting for business combination. In the case of development CWIP also, we have to consider 2 lakh fair value, not the book value. All other items of asset liability, we will consider only the book value. So that's why we have a note 1 and 2 for this working note. You might ask me, sir, should I prepare the working note like this? I don't think it's required. If you have time, you can do it, not a problem. So that's how you got the total, non-current asset after the acquisition date fair value. Similarly, inventory, all these things considered. Other current asset, all book value, 1/3 we should take. See, 2 lakh, 1/3 is 66,660. Other liability, 1 lakh, 1/3 is 33,330. You want to be very precise, take it to the last rupee, but don't consider decimal point. It's a waste of time. It will, consume a lot of time in the exam. So that is how the numbers shown in the balance sheet have been considered. Okay, very simple. 1/3 of assets and liabilities. Other than PP and capital work in progress, 1/3 should be taken, but of the fair value, not the book value. So whether you will prepare this working note or not, I leave the option to you. Even if you don't prepare, it's not a problem. Okay. But this is very important. Fair value of PP is 5 lakh. Of that, 1/3 is 166,650. Development CWIP 2 lakh fair value, 1/3 is 60. That is how you got that number, because book value is 3 lakh and 1 lakh, but 1/3 of that is different number. Then why did you take 166 and 666? It's because you have to consider the fair value. So better you can show this working note. Without this working note, you cannot present any solution on problems relating to business combination. Goodwill, gain on bargain purchase. How to do that? Take the net assets, compare with consideration. Difference, could be goodwill or capital reserve. So we have given it in detail. We have taken all the non-current asset as on 30th June by taking fair values or book value as the case may be. Current asset, friends, remember, we should not consider cash and cash equivalent, because the cash and cash equivalent of Z is not taken over. Other than that, all current asset taken over. That is the 1/3 of the book value. Non-current liability, current liability, deferred tax liability. We need to go to working note number 3 to get this number. Assuming we have already done that, it is 29,997. So based on this calculation, it appears the net asset acquired is 1,19,988, whereas the consideration paid is 1 lakh only. So similar to the earlier problem, what you acquire is worth 1,19,988, but what you give is only 1 lakh, resulting in a gain on account of bargain purchase, which should be taken to other comprehensive income and shown as capital reserve under equity in the balance sheet after acquisition. So this is how we got the gain on bargain purchase, but that is based on the calculation of the deferred tax liability. So that we will have to see now how you got that 29,997. But see, friends, you cannot just blindly consider gain on bargain purchase, but goodwill can be recognized because that is in the nature of a capital loss or a consideration paid to acquire reputation of the other company. But where you say it is a gain, prudence, whether to recognize the gain or not. That is the reason why such gains are mainly taken to OCI. So why it is taken to OCI? I believe you should be writing something like this, not exactly the same, but we should be very, very clear that the gain has actually been realized. If it is only an estimation, the gain has not been realized. There could be some, what is that? Doubts about that. You should not recognize it. But in this problem, it is very clear that the gain has arisen. The participating right has been acquired. So necessarily, it should be recognized as a gain on bargain purchase. So I would not say write everything what I given on the slide, but definitely write something why you are recognizing the gain on bargain purchase in other comprehensive income. Now, friends, how to calculate the deferred tax on account of business combination? Only two things. PPE, fair value certain amount, tax base is different. Similarly, capital work in progress. Difference could be taxable temporary. 30% of that is deferred tax liability. Very simple. See, this is not the only way in which you have to do it. You can do it in different way also. But what they have done is they've taken total assets taken over, total book value of asset and all. We can do this in a different manner also. Let me tell you, it's simple. PPE book value was 3 lakh. We take it 5 lakh. No, difference is 2 lakh. Capital work in progress, book value 1 lakh. You have taken it 2 lakh. So 1 lakh difference. What is the total difference? 3 lakh. So in the balance sheet after acquisition, the assets are recognized at a value of 3 lakh more than the tax base. So when carrying amount is more than tax base, it gives rise to a temporary difference which is taxable in the future. So what is the temporary difference? On that you apply 30%. You will get the answer. As a deferred tax liability, 29,997. That's all. Very, very simple way you can get the answer. Or you want to do it in this manner, we can do it. Not a problem at all. So are you clear, friends? That's all. Easy way to get the answer. Now, what is the total difference? 3 lakhs. But they are taking only 1 lakh, one by third of that. No, 1/3 of that. That means temporary difference will be 1 lakh only. On that 1 lakh, 30% will be 30,000 rupees. Here it is taken as 29,997. So this is not the only way in which you can determine the deferred tax liability. You can just compare the two assets, PP and capital work in progress. You can directly determine that from that manner also. So whether the acquisition has happened step by step, I don't think it is like this. It does not happen step by step. Just one shot they've acquired 1/3. So on the date, the company X has acquired control. Therefore, the step by step acquisition principle need not be followed. If only a business combination is achieved in stages, then what we should do, we have to remeasure the previously held equity interest. Then we have to recognize the gain or loss in the P&L or OC as appropriate. But earlier to this acquisition, company X did not have any interest in company Z. So therefore, recognizing the gain or loss in P&L OCI does not arise at all. That's what I told you. This is not a case of step acquisition. It's an acquisition on a particular date. That's it. So therefore, no need to find the fair value of previously held equity interest and recognize the difference in P&L or OCI. This is not a case of step acquisition. Friends, I have come to the